Ladies and gentlemen, welcome to our results conference. We will communicate the consolidated results for the first half year and the second quarter of 2020. It's become a tradition that we meet online. We know that you are out there, so please receive our best, and we invite you to ask questions. I'd like to welcome our speakers today who will present our results. I'd like to welcome Mr. Przemysław Krasicki, Finance Director at Lotos Group, the Head of Investor Relations, Mr. Wojciech Zenkteler, and my name is Adam Kasprzyk. I'm the Communications Director at Lotos Group, and there is more of us here, but we're keeping the 1.5 meter social distance. Still, we're waiting for your questions at the email address we've communicated earlier. Please don't hesitate to participate in our conference. And now Wojciech Zenkteler will begin. Thank you very much, Adam. Ladies and gentlemen, welcome. We are going straight to the results, slide number 4, which is the summary of key parameters we'd like to discuss. First, it needs to be highlighted that we're closing the first full quarter of the pandemic. We need to bear in mind that the gas and petroleum industry, unlike other industries, were hit in two aspects. First, the pandemic hit the entire economy, and secondly, we have the price war of the OPEC countries, which just before the pandemic have led to a decrease in prices of crude oil and natural gas, which affected our results. The half-year LIFO, our key parameter, is at the level of 723 million zlotys, which is the result of worse macroeconomic situation, worsening environment, which we are dependent on. The quarterly EBITDA is just of 52 million zloty, which is the result of the worst situation in the entire quarter. But what we'd like to stress is that this result or this effect was also the one that affected PKN Orlen. However, the other company is much more diversified, so it was less affected. And this is all also added by the financial effect of all the crude layers. So according to LIFO, the key parameter to our efficiency or performance has made us take into consideration the crude from the previous period, not this one. While the previous period saw higher prices of crude oil, so methodologically the cost of crude was much higher, which decreased or affected badly the EBITDA without one-offs. However, in this half year, we've launched our key investment, which is the delayed coking unit. So this is the largest R&D project, and Afra that was concluded. And this shows that those turbulences in terms of layers and our reserves didn't affect us this much, while cash flow is what characterizes our operations, and these were at the level of over 1.8 billion zlotys. The net debt to LIFO EBITDA is of 0.9, which is a safe buffer, which is to our strategic goal of 1.5. We will be dispersing a dividend. The general shareholders meeting has approved 1 PLN per share dividend, which is the 185 million zlotys, which will be paid on the 12th of September. This also shows our capacity to rapidly adjust to the situation which beset the industry. Our process capacity was maintained at the 98% level, while the majority of refineries in Europe have reduced by 20 or 35%. The general decrease was around 16% for all the refineries globally. While we act quickly, we adjust to the market, and the moment the jet fuel demand disappeared, we have reduced to zero the production, which allowed us to redirect the production flow to other fields. Kudos to our trade department, which launched channels for sales, which earlier were unused. So we exported some of our product and reacted with flexibility to this situation. As described here, you can see the charts. So we have 723 million, which is a lower level than the previous year when the LIFO EBITDA went to 1.9 million. But if you look lower, we have the operating cash flow, and which keeps our situation safe. Refining and crude oil throughput, as you can see, we are working at peak capacity in the first half year, and the daily hydrocarbons production has grown since last year. Now, slide number 6. It's a similar situation, but in a quarterly basis. So quarterly, this reduction is very strong, but we need to take into consideration the effect of the older crude layers, which caused this decrease. The throughput also was reduced, but the second quarter in 2019 was a perfect moment. We were operating at full speed, so the situation was different. Here in the left bottom-hand corner, you can see we are maintaining stability, and the production of hydrocarbons is lower than in the previous quarter, but this is the result of reduced production in the Crude field, but that was a projected change. Now, Mr. Krasicki will take over and describe the macroeconomic environment.
Thank you very much. Good afternoon. Now, macroeconomic environment, as you know, is of critical importance, of key importance when it comes to financial results, which can be obtained by any refinery. Now, let's start by comparing the macroeconomic environment, that is the numbers from the market, with our strategic goals, assumptions. As you're going to follow this slide, you'll be able to see one key trend which has affected the market, that is decreases in practically all areas in relation to our strategic assumptions. Starting with Brent dated, you can see 36% negative difference between the average stemming from the strategy accepted by the Lotos Group for the year 2020, from $63 per barrel to $40 per barrel average for the first half of 2020, and even lower average for the second quarter of 2020, that is $30 a barrel. Now, even a greater difference can be noted when it comes to natural gas. We can see a 62% difference between strategic assumptions of the Lotos Group in the amount of $35 per the equivalent of a barrel, and the current average $13 for the equivalent of a barrel. Now, the second quarter itself, the average for the second quarter is even lower, $9 per barrel equivalent. Now, moving on to product crack spreads, we're starting with gasoline. As you can see, gasoline is a product which has the greatest difference when it comes to our strategic expectations, which were expressed in the strategy, and the actual data from the market. We see a drop by 61% in relation to the strategic plans, which were at level $166 per ton of gasoline. For the first half of 2020, we have $64 per ton, and the second quarter even lower, $47. And now diesel, somewhat lower drop, less of a drop, 31% in relation to our expectations, currently $81 per ton for the first half 2020, for up to in relation to 117 in our strategy for 2020. Currently, for the second quarter, also lower price, $66. As far as heavy fuel oil, this is the only product crack which has an opposite trend, shows an opposite trend. We can see still negative numbers, as you can see, but the expectation was minus $223 per ton. Now, in the first half of 2020, this decreased to minus $111, and for the second quarter of 2020, it's even better because it's only minus 63. So we can speak about a small improvement, but currently the impact of heavy fuel on the refinery in Gdańsk is not that great. Now let's move on. On the next slide, we can see basic parameters, financial parameters when it comes to diesel and gasoline. Let's start with the rate, FX rate. This is actually the most important relation for our company, dollar to zloty. As you can see from the second quarter of 2019, we've seen the dollar get somewhat stronger, up to 4.09 in the second quarter of 2020. As far as GDP, Polish GDP growth, well, in accordance with the data from the Central Office of Statistics, in comparison to 2020, where we saw relative stability, the level of that growth is above 3%, and in the second half of 2019, over 4%, in fact. Now, as a result of the pandemic and the lockdown, we've had a dramatic drop to minus 8% in the second quarter of 2020. And following that, we can see, in step, we can see a trend on the markets when it comes to diesel consumption. In 2019, consumption in the second quarter dropped from 5.6 to only 3.9 in 2020. So we see a drop of over 20%. And now gasoline consumption, as you can see, also a significant drop, even greater in fact, from 1.6 million of cubic meters to 1.3 million cubic meters. So a drop of over 35%. Of course, these trends, these tendencies, their main cause is lower demand for oil products connected with various regulations, restrictions connected with mass transport, movement of people, closing of borders. In Poland, we felt it most, especially in retail sales, that is at petrol stations. Now, let's move on to the next slide. Here we can see graphs concerning crude oil and natural gas prices. So, in other words, what it looked like in the previous year, and as we can see in the Brent oil, we can see a drop from $69 per barrel to $30 per barrel, and we can also see that the tendency, the dropping trend started in the first half of 2020. The prices were relatively stable until the end of 2019, about $60 or so, and currently the price is about $30 in the second quarter of 2020. As far as natural gas, here we can see a drop from 23 to 9, also quite stable. The price was quite stable last year in 2019, about 20. Now in the first quarter of 2020, we didn't see signs of a big drop, but in the second quarter, the drop is quite dramatic, as you can see on the left-hand side of the slide. Now, on the right-hand side of the slide, we can see the trend of product crack spreads. As I've mentioned, most affected by the pandemic was gasoline, from $157 per ton, a drop to $47 per ton. Crude oil from $90 to only 66. And when it comes to heavy fuel oil, the tendency is quite the opposite. So the negative $137 per ton has decreased somewhat. That is improvement to the amount of minus $63 per ton in the second quarter of 2020. Moving on to exploration and production, and I'm turning the floor over to Wojtek Teller. Thank you very much, Przemek. Ladies and gentlemen, slide number 12, in which we can see all the areas where we actually extract oil and gas. Poland on the left, Baltic Sea, in the middle, Norway, the North Sea, and also in the upper right-hand side, Norway as well, Utgard, the new site. And the drop, which I already mentioned, the characteristic of the Utgard site is that we have a very high level of production and then a rather intense drop. And that is quite surprising, in fact, continues to surprise us. In fact, it's lower by 3,000 barrels today than when we started. Now, I'd like to point your attention to the middle rectangle, the bottom half. That is the cost of extraction in Norway, lifting costs in Norway. As you can see, the level of extraction in Norway is the highest, and it's about 80%, in fact, of what we extract. And the direct costs of extractions are single-digit, in fact. So thanks to this very effective portfolio of our assets, we are able to, despite this exceptionally difficult situation on the oil and gas market, and the drop and the graph that Przemysław Krasicki has just told you about, where you could see the dropping green and blue lines for oil and gas, which were going down to a single-digit level for gas and to about $30 for oil. Now, despite such situation, our asset portfolio is holding out quite well considering the very difficult circumstances. Slide number 13, please. Here you can see a mix of oil and gas divided by quarter on the left-hand side, year on year. Higher production and production increasing by 10% or so in comparison to the first quarter. Well, it's lower, obviously, but already given you the reason. That is the dropping extraction from the Utgard side. And what's interesting, and I would like to point your attention to that in the context of sales in the lower right-hand corner, you can see that in the first half we've been able to reach a structure which we have actually assumed for ourselves as part of our strategy. So when we were entering into the current strategy, we had a somewhat twisted strategy or directed towards gas, but now our goal is oil, more so. And we are taking steps in that direction, and we are able to reach quite positive effects, in fact. Next slide, please, slide number 14. So total recoverable reserves, 2P reserves, you can see the results in relation to what has been left. So the reserves are quite substantial and we'll be able to produce based on those for a while to come, especially until the times that the price is increased. Now moving on to slide number 15. Here we have more details regarding our results. Of course, first we've talked about the clean data, clean a bit, which reflect the strength of our assets. But of course, we cannot forget what the convention of facial reporting obliges us to do. So on the right-hand side, you then have this minus 173 million, and this is a consequence of deductions on our production assets. And these deductions stem from the worsening prognosis of long-term basis, which results in the fact that at this level of prices, well, the impairments, the deductions have to be actually carried through. As we know, the situation has not been so bad for a long time. Obviously, we hope it's going to reverse, and it is going to reverse in a while. So the level is quite substantial, as I've said. We treat it as a single-time event of non-cash character. Now, if we were to exclude that effect, then the clean EBITDA for the 6 months does the level of 231 million. Now, moving on to the next slide, slide number 16. We can see the similar picture that you had seen before, but broken into individual quarters. And here, what I think is important and worth underlining, and what confirms the resistance of the assets to the difficult situation, is the second quarter, which had the lower oil and gas prices for a long time. Now, despite that, the clean EBITDA is being maintained at the level of above zero. Now, moving on. The second of our reporting segments, I would like to ask for slide number 18.
The production structure is the following. In the first quarter, the structure was slowly shifting towards our targeted level, which we'll be using after the DCU unit launching and within Afra project. But in the second quarter, as you can see, we have 56 middle distillates and a larger share of heavy products, which is a negative tendency, but this confirms our ability to adjust to the situation. In the second quarter 2020, we had an unusual situation in which the rapid drop of basic petroleum products prices has caused the bitumen prices which we produce, which is part of the heavy products, has been for a longer period of time more or less on the level of diesel fuel or even higher. So, as part of optimization, we maximize the bitumen production, so the percentage representation does not look good, but factually this was a beneficial situation. Moving further, the same picture which we've seen for production and trade, 6 months of 2020 on versus 6 months of 2019 for clean EBITDA, 51% down to 505 million złotych, but here we are missing certain part of the result due to the older layers of crude, which had a different price than that considered in the LIFO. So this affects the general result of the refinery. So the retail result is untouched. It's lower due to obvious reasons. Our petrol stations were affected by first reduced consumption of fuels in Poland due to pandemic and the reduced number of trips, and after that the closed shops, which prevented us from benefiting from non-fuels margins. Here we have a quarterly result. We see high variability of results between the first and second quarter due to the need for appreciation of our reserves portfolio. We needed to carry out the impairments, and this is the 880 million, which you see in the bottom, which was completely reserved in the second quarter because the prices went up. So from $14 at the end of the first quarter, we moved to 40 quarters. So first we had the impairments and then we had the reversal. So this shows that these movements that we need to perform in regards to our inventory change quickly. And for proper reflection of our results, we are presenting the clean figures. I'd like to also point to the right-hand graph where we see that we've sacrificed the result of the refinery, but this is at the expense of the prices on petrol stations. But I'd like to reiterate that this 15 million that you can see as LIFO EBITDA would have been much higher if not for the older crude layers. So we are not trying to rebound using retail, and it's just a matter of convention that we've picked, and our results as a refinery are in fact much better than those seen here. This would be all from me, and now to Mr. Krysicki, who will summarize the consolidated financial results. Moving to the closing part of our presentation, which is the summary of the consolidated financial results, I'll just add that the half-year financial report was prepared using international reporting standards and has been audited by an auditor who prepared a review which was free of any remarks, so we can confirm that the auditor has agreed with the figures we have presented in our financial reports. Now, moving on to the slide itself, in the first half of 2020, the Lotos Capital Group has generated an operating result as a clean EBITDA according to LIFO on the level of 723 million złotych. Let me stress once more time, as Mr. Wojciech Zengteler mentioned, we need to take into consideration the financial accounting effect of all the crude layers. This is a substantially lower result than the one we've obtained in the first semester of 2019. It's lower by over 700 million zlotys, but the negative net result for the first half year is 1,388 million zlotys, and it was definitely lower than in the comparable results in 2019, when we had a profit of 673 million zlotys. The main reasons that need to be mentioned and weren't mentioned thus far is the reduction of retail profits, which in the first half year were slightly over 10 million zlotys, billion zlotys, which is 4 billion less than in the same period last year, which constitutes 28%, and this is the result of lower petroleum prices and petroleum product prices. It's also lower by 1.8 billion zloty was the result of sales caused by the dropping price of crude oil and product crack spreads. The costs of sales grew by 5%, which is the result of the FX differences of dollars to zlotys, and minus 7 billion zlotys due to the upstream impairments. Comparing these results to EBIT from 2019, which was minus 1.6 billion zlotys, is the result of the LIFO effect of 1 million zlotys. One-offs, it's 786 million zlotys. As you can see, over 90% is the E&P assets impairment caused by the international accounting standards, and also there is also the depreciation amount for the first half year, which is the 548 million zlotys. We have a very similar decomposition for the second quarter of 2020 versus the same period in 2019. As you can see, we have an even greater difference in generated EBITDA. The clean LIFO EBITDA in second quarter in 2020 versus second quarter 2019, we have a 93% difference, which is a negative result. This decomposition also presents a similar LIFO effect of 400 millions and depreciations of almost 300 million zlotys. On the left-hand graph, you'll see we have 439 million zlotys on assets impairments and minus 815 inventory write-back due to the pricing of our inventory price, which was lower than the first quarter when we had the major write-offs, and we needed to perform all these operations in accordance with international standards. Here we have operating cash flow versus capex. As you can see on the left-hand side, in the second quarter 2020, the Lotos Capital Group has generated over 1.7 billion of cash flows, billion Polish zlotys. The main cause was first the use of factoring at the end of the first half year of 2020, and due to substantial reduction of inventory and also liabilities for products and services. CapEx in the first half of 2020 was lower than in the comparable period in last year by 116 million zlotys, but the structure remained fairly similar. The largest singular expenditures were directed to IME field. It's 120 versus 149. B8, that's 68 million zloty, which is operated by B8 company within Lotos Petro Baltic. The capex for Afra, it's much lower, 63 million, but this investment was practically concluded in the first half of 2020. As for the petrol stations chain development, the amounts were similar as in the last year, slightly lower expenditures for the remaining Heimdal and Sleipner fields in Norway. The other smaller investments quite similar as in last year, this year, 110 million zlotys. And now moving on to the last slide.
The final slide summing up the financial results with basic indicators of that. First of all, net debt. Here you can see that net debt is definitely lower, 2 billion zloty in relation to 1.9 at the end of 2019, despite a somewhat higher course of dollar. At this point, I'd like to just point your attention to the amount 1.3 billion now out of the amount 2 billion. That is the participation in MFS 16. The annual conference in March, we've explained that it was essential. It was a reconnaissance of the leasing effect, so-called MSF 16. So definitely just an accounting procedure, not connected with any cash flow, but which nevertheless does affect the level of liabilities due to leasing obligations. The gearing ratio currently 18% in relation to 23 at the end of the year, and 11 percentage points of the MSF 16 effect. And final indicator, which is one of our major ones mentioned in the beginning. So net debt to clean LIFO EBITDA, it seems that it's at a very safe, very good level, 0.9%. And here you should also notice that 0.6 out of that is the impact of the MSF 16 standard itself. And that's all from me. Thank you very much. I'm turning the floor over to Adam. Thank you very much, Mr. Director. Time for Q&A. We've received a number of questions from Business Alert. Some questions. Let me read the 3 questions. Now, the first question, at what phase is the Lotos talks about the recompensation for the contaminated oil from Russia? Now, question number 2, how does Lotos want to engage in the strategy of hydrocarbon for Poland? How will its potential change after connecting with Orlen? Now, how to continue to develop the Gdańsk refinery, what investments in that, and in what price, and what are the plans, and what are actually the plans that are considered by Lotos? Now, the first question, what is the phase of talks when it comes to the oil, the polluted oil from Russia? Thank you very much. Regarding the first question, the compensation for the contaminated oil, we are talking. It's an ongoing issue. We still don't have any final results, but we are progressing. And once we have concrete results, concrete messages that we can share in connection with that process, then we'll obviously inform everybody about it. Now, second question, how does Lotos want to engage itself into the carrying out of the hydrocarbon strategy of Poland, and how will its potential change after merging with Orlen? Lotos has been engaged in all the projects connected with modern alternative forms of power supply. Of course, hydrogen is being perceived as the fuel of the future. It's an important part of strategy of many global players, so its importance is increasing. It's probably going to have a much more important place in the fuel mix in the future. So far, Lotos has been quite engaged in the project Pure H2, together with the Polish power lines networks. We started works on optimized and ecologically clean strategy for producing a so-called green hydrogen. At the same time, what's worth underlining, together with PKN Orlen, we have also become involved with works with the Ministry of Climate on preparing hydrocarbon strategy for Poland. Of course, we have regional strategy as well. We have signed letters of intention with major cities in Poland, those cities which could provide with hydrogen, for example, for propelling their buses. Definitely our future in the PKN Orlen Capital Group is going to open up a new way for us to intensify our actions in these fields. I think that Lotos has a great history of being a leader when it comes to when it comes to ecology, to the environment. The refinery we have is one of the most modern, most ecologically friendly ones. Very quickly we've moved to being gas-powered, so I'm sure that this potential, this energy, will be able to be made used of also when it comes to hydrogen development. And the third question regarding investment, how to continue to develop the Gdańsk refinery, what investments and at what price are planned, and which ones are considered by Lotos. As far as investments are concerned, I think we should go back, it's worthwhile to go back to our strategy, because all the investment projects which have been planned are being conducted. Obviously, we're at various stages of completion. Here I can mention the hydrogen recuperation node. The whole investment process is pretty much being completed. Starting is planned for the third quarter of 2020. We are building another fuel providing station, 100 million zloty in budget, and the project is going to be completed at the end of this year as well. We also have a large project which has already been mentioned, HBO project, and here the pre-feasibility levels works are being conducted, and the final decision is expected in the second half of this year. We also have projects which are at a somewhat lower level of advancement, but of key importance as well when it comes to the development of the Gdańsk refinery. I'm talking about the marine terminal on the Dead Vistula, which allows for loading and reloading components and singular products up to the 5,000 tons in volume. We have a plan to increase the efficiency of the installation through modernization of the installation of the oil distillation and hydrocracking MHC installation as well. And of course, we also have a project which we have talked much about in the past, and we've informed the public about it. That is participation of the Lotos Group in the polymer Police project. Thank you very much, Mr. Director. And more questions for this time from the Polish Press Agency, where Piotr Roczek asking questions, and I bring the questions. How do you see the impact of Afra installation on your EBITDA result? Is it in accordance with your assumptions? Second question. Now, the deviations of the macro results in relation to your strategic goals, will it influence the correction of planned investments? First question, please. Let's ask about Afra. How do you see the effect of the Afra installation on EBITDA? Well, thank you very much for this question. In accordance with the first half-year report, we've informed that currently this marginal impact of the Afra installation is below our expectations. As you know very well, we, in this incremental profitability, used the amount of $2 per barrel. the number $2 per barrel, and the combination of macro factors, well, and these $2 have proven themselves in recent years. But in this new era of COVID, it's no longer the case. We are dealing with a very large price change when it comes to diesel and diesel margin, when it comes to barrel price, and on the other hand, we also have the heavy oil defending itself very well. Now, the profitability was based on the difference between the two products. And in reality, in mass, we are basically giving up on heavy fuel, and we were replacing it with diesel. That was how it was supposed to function. Now, today, in the current conditions, we're not maximizing the work of the DCU installation, and also with the model assumptions, the current macro conditions are not supportive, and in the second quarter of 2020, it was pretty much below $1 on average. So we are waiting for the normal situation to return, and then Afra is going to continue at the level, hopefully, that we assumed in the beginning. And the second question, and now the deviations of macro conditions in relation to your strategy, will it impact corrections in planned investments? Well, as I've said in the beginning of my presentation, of course, the macro situation itself, to a very significant degree, impacts the operation of the refinery. It shapes the levels of margins that we obtain from our fundamental activity. And due to that, of course, it can have an impact on our financial capabilities and also on our investments. Now, as you could see in our presentation, when it comes to generating financial flow, it seems that, at least in the first half of the year, these are very good results. In fact, of course, macro does have an impact on upstream investments because, well, due to the price changes, certain products might not prove profitable. But I think we can rather speak about shifting certain investments rather than making certain drastic decisions when it comes to continuing or discontinuing a given product. And just as Wojciech has mentioned, everything is going to depend on whether the economy will be affected by the so-called second wave of COVID. We are optimistic. It seems that at this point, the economic situation, is slowly returning to normal. Hopefully, if the tendency is going to last, then it shouldn't have a significant impact on the continuation of the investments that I had mentioned before. Thank you very much, ladies and gentlemen. We've received many more questions, and obviously we are going to answer them individually on behalf of the Lotos Group by our communication office. Thank you very much for the conference. Thank you for your participation. Thank you for your questions. And the ones that we haven't been able to answer, we are going to continue to inform and answer those questions that we've received. Press information release has already been sent and already have been published, pretty much done by the Customer Relations Office. Thank you very much for today's meeting. I would like to thank Przemysław Krusicki, the Financial Director, and the Head of the Investor Relations, Wojciech Wilgenteller. Thank you very much for your participation. Thank you very